Hello, I'm Tastzidis, and this is this month's edition of the Transition Edge. Each month, I put together a newsletter for business and property owners who are seriously thinking about the next chapter, whether it's 2 years, 5 years, or 10 years away. This video is a quick preview of some real sales from around Australia and New South Wales and what they're telling us about the market or where it is right now. Let's get into it. Now, when I sat down to write this month's newsletter, I was going through to say the market is giving us a clearer signal than it's been for a while. And that's still true. But within days of writing, a couple of things shifted. Inflation was sitting above the RBA's target. Trend mean came in at 3.4% in January, heading the wrong way. Then the Middle East escalated. The Strait of Hormuz got disrupted, and oil went from the mid-60s to around the $80 a barrel almost overnight and continues to move the upward spiral. The RBA governor has since introduced another rise this month. So the picture is mixed. There are positives, and I'll show you this in a moment. And I think it's important to be straight with people rather than paint a rosier picture than reality warrants. Here's what I've learned over 40 years. The owners who end up with the best outcomes don't wait for certainty. They use whatever clarity exists to strengthen their position. There is clarity right now, and you just have to know where to look. The sales I'm about to walk through with you draw from various market sources I track each month, and useful because they show us what buyers are actually paying now across different sectors. Let's look at what's actually selling and what the numbers are telling us. Let's firstly look at industrial. An example was a property in Smithfield, a small industrial site in Smithfield, just over 1,000 square metres, freehold, a brand new 6-year lease to a national company. Sold for just over $2 million on a yield of 4.86%. Now, is a sharp yield. But here's the point. When you've got a recognised tenant, a clear lease, a well-documented asset, a well-located asset, buyers will pay for security. The covenant matters enormously. I see owners underestimate this all the time. They think the building is an asset. Often it's a lease. Let's move on to retail. That's an interesting comparison here. Let's compare Kirribilli, which is different, to Gundagai. It is a sharp contrast, but it shows you a few things. This one's interesting because I want to show you the two ends of the retail spectrum. Kirribilli mixed retail office right in the heart of one of Sydney's most affluent suburbs. Sold for $9.1 million at a yield of 3.47%. That's incredibly a sharp yield. But buyers there are paying for position and scarcity. There's simply not much of that available. Then let's contrast that to the drive-through restaurant down in Gundagai, regional New South Wales, about 4 hours southwest of Sydney, on nearly 10,000 square metres, leased to 2030 with options to 2045. Strong income, $382,000 a year, and it's sold for 9.43% yield, nearly 3 times the yield of Kirribilli. Why? Because the buyer is being compensated for the risk, location risk, reletting risk, if a tenant leaves, the fact that there's actually only one use for that building, high yield, but they're earning it. The lesson for owners, when your asset sits on that spectrum, prime, secondary, regional, but has an enormous impact on what the buyer will pay. It's worth knowing exactly where you sit before you make any decisions. Let's move on to another one. This property is in Bondi Beach. This one is different. This is a property I was directly involved with, and it's worth telling you the story. It's an interesting one. It's directly relevant to anyone in hospitality or accommodation. I acquired a property in Bondi Beach for a client for around $5.5 million. This is just before the cinema became, about 2 years beforehand. It was a motel at the time, repositioned it, converted it into a backpacks accommodation, right location, right hotel for that market. The property has just sold recently for around $60 million. Now, I'm not telling you this to be flashy. I'm telling you because it illustrates something I talk about constantly. The combination of the right location, right operating model, the patient ownership creates value that simply cannot be rushed. Time in the market, not timing the market. That's a 40-year lesson right here. So what it means to you. So what do you do about all of this? If you own a business and a commercial property and you're somewhere between 3 and 10 years from retirement, the question isn't what's the market doing this week. It's where my asset sits on that prime to regional spectrum. Are my leases cleaner and readable to a buyer? Am I asking the right questions now? And there's still time to act on the answers. This month's newsletter goes deeper than all of this. The commercial property outlook, tourism momentum for hospitality owners, and some regulatory changes around the capital gains tax concessions that I think a lot of people aren't across yet. If you'd like the full edition, all 4 articles plus complete sales breakdown, the link to subscribe for the Transition Edge newsletter is in the description below, and it's free. It's monthly, and it's written specifically for business and property owners who are serious about their transition. I'm Tastzidis. Subscribe to this channel, and thanks for watching. I'll see you next month.